And I have to ask, where do you invest your money? Because you've been very diversified throughout your career and
Yes.
income.
Gold, Graham.
Birch gold.
Birch gold. So where do I invest my money? So as I'm sure your listeners know, there's a big difference between wealth and actual like liquid assets.
Sure.
So obviously I am invested very heavily in Daily Wire in the sense that I own a large chunk of Daily Wire, and that's a very large business. So if you were to assess my net wealth, that is a large portion of my net wealth. However, in terms of like my actual liquid asset base, I have always thought, in the same way that I think about my career, that if I cannot dedicate a lot of time to a thing, I shouldn't be doing the thing. And so I have financial advisors who essentially, I told them, I'm young, I have a very solid cash flow, so I want you to take the best diversified portfolio in sort of your highest risk category. So I'm willing to lose the money, right? Like basically there's like my solid stuff that I want. There's a certain percentage of my portfolio that I think of as like very solid. It's not going to be 80%. Yeah. And then there's like 15%, which is in like the more high risk category, maybe 30% versus 50. And then and it's probably go like 50% is in very kind of low risk, solid returning assets. 30% is in more of a high risk bundle. 20% is reserved for like, go for it.
Sure.
But when I say go for it, they don't really do that. There's only one investment. I've only made one investment in my life where I personally, quote unquote, picked a stock, because I don't think that you can day trade without really knowing a lot about a thing. And my strategy on investment is Graham Dodd's strategy. So I Benjamin Graham and David Dodd. So which is the same strategy Warren Buffett uses, which is essentially you're not investing in risks. You're mitigating your downside risk and looking at the possibility of upside. And when you buy a piece of stock, you're not buying a piece of stock because you think the value is going to go up. You're buying a piece of stock because you want a piece of that company, because the company is well run, has a good product, has good upside. And so I don't buy things to sell them. I buy things to hold them.
Yeah.
And so again, I'm young, and that's all you have to do, right? I mean, if you just buy things to hold them and you don't pick like the worst stocks in the entire world, the magic of compound interest is a thing. And so for me, it's the first rule is don't lose. And then the second thing that you can do is look at potential upside. So for example, I'm now a major stockholder and on the board of a publicly traded NASDAQ corporation that's like a biotech company. The way that I picked that stock is I happen to know the CEO, and I know that he's a very solid guy, and I know that he makes good decisions, and the stock was wildly undervalued. I know how much, through public disclosures, I knew how much cash they had on their books, and I saw that the company was trading at 1/2 of its cash. And so I was like, well, it's trading at 1/2 its cash. From all available public indicators, it doesn't, and their last few quarterly reports, they don't have like significant burn. So why is it trading at 1/2 of its cash? That's an undervaluation. So I bought up a bunch of that stock. And the reason it was trading under its cash is because it had a drug, it failed a phase 3 trial, it dumped from $20 a share to like $2 a share. And so everybody else was like, they're buying it on the way up. And I was like, well, no, I'm gonna wait and now it dumped, but it's got a big bag of cash right here that's worth at least $4 a share. I can buy it at $2 a share. There's no risk.
Yeah. What about alternative investments? Because I've noticed that's a Zenith Rolex Daytona.
Yeah, you know your watches. Yeah, that's right. So yeah, I do have a bit of a watch collection, mainly because they're pieces of art. But again, buy to hold, meaning like watches as sort of a hobby / investment are good, because depending on the brand, and that's basically you need one of the big three or Rolex. Those are the ones that will actually accrue in value over time if you hold on to them long enough. There are a lot of other beautiful watches. Jaeger makes beautiful stuff, but tends to, on the gray market, sell for less than its price. But watches are great because you get to wear them around, and then if you don't like them anymore, you can sell them and not lose any money, which is more than you can say for the vast majority of other sort of luxury assets. So you buy a nice car, and within 5 seconds, it's worth half of what it was when you bought it. So yeah, it's a...
That's cool.
I like
That's a great watch. I have the original 1969, the El Primero. So it uses the same movement as that.
Yeah.
So what I really wanted was the stainless steel version of that, and then prices went nuts.
So they did, but now they're coming back down because
slowly.
all the Bitcoin guys had bought watches, and then when Bitcoin went blast like a year and a half ago, then this is the mistake that I made. I bought a couple of Pateks, and I bought them when like at the height of the, like just on the other side of the height. I was like, oh, they're dropping. We're good. I didn't wait long enough, and so. Yeah, I didn't do well on those. But again, my view is I wasn't selling them in the next year, so what do I care?
Right.
I just told I'll give my son. That's fine.